Usually we begin with something that happened.
But not tonight. Tonight we begin with something that didn't happen.
The economy didn't grow, not in the first quarter of this year. It shrank at an annual rate of 0.3%.
It's the first time in 3 years since COVID that the economy has receded, adding to the prospects of a recession.
Continuing with the economic report card, the good news is the threat of inflation is easing. Consumer prices rose at an annual rate of 2.3% in March, down from 2.7% the month before.
But that could change as the effects of the tariffs kick in, making products more expensive. As they tried to beat the price hikes, consumers increased their spending in March by a solid 0.7%.
And here to put it all in perspective for us is Kelly O'Grady. Kelly?
Yeah, there's a disconnect between where the economy stands and where it could be going. And we saw that in the report on gross domestic product, or GDP. GDP measures all the economic activity in the U.S. And last quarter, for the first time in 3 years, it shrank.
Most analysts expected the economy to grow somewhat in the first quarter of 2025.
100 days ago this week, we inherited the wreckage of 4 years of economic disaster.
President Trump blamed the previous administration and said the full benefits of tariffs haven't kicked in yet. But White House trade advisor Peter Navarro tied slowing growth to businesses and consumers stocking up ahead of tariffs.
We had a fairly extraordinary surge of imports that was totally driven by the rest of the world trying to get their products in here before the tariffs took full hold.
Imports in the first quarter surged more than 40%. Since the U.S. bought more than it sold, that caused GDP to go down. The brightest spot in today's report was a 22% increase in money companies spend to build their businesses in the U.S.
That's Apple for $500 billion.
The White House spent this afternoon with CEOs from NVIDIA to Johnson & Johnson. But over the last 3 months, we've spoken to small business owners, such as Lynn Alessi, who depend on imports. She told us the tariff uncertainty is causing paralysis.
I have all my customers putting on the brakes, saying, what are we going to do? Where can we move to?
Alessi's client, Karen Sadaka, said producing clothing on a large scale in the U.S., like she does, would require a big overhaul.
It's too much, too fast, and you're hurting companies. You just can't turn around on a dime and say, okay, well, we're going to increase you 40, 50%. Where's the infrastructure to make the goods in this country?
So, Kelly, if the economy is being affected by these tariffs in all these different ways, is it possible to look through all of that at what a kind of the central economic picture looks like?
Yes, and that was actually the silver lining of this report, because when you strip out all of that import and export volatility, the tariff noise, the underlying economy, it's what we call core GDP, that actually rose 3% last quarter. Where I'm concerned, though, is consumer spending drives 2/3 of GDP, and that came in a bit weaker this quarter than it normally does. So if negative consumer sentiment leads to less spending, you could still have a GDP problem next quarter. And let's remember, 2 quarters of negative GDP growth back to back indicates a recession.
The R word. So what's the Fed likely to do here?
Oh, they're between a rock and a hard place, because a negative quarter of GDP, this would be sparking a conversation of when are we getting that rate cut to fuel growth. But with the threat of higher inflation because of these tariffs, cutting rates could spur inflation higher. So next week, the Fed's meeting, we're expecting them to pause unless we were to get some kind of wild jobs report on Friday, but that's unlikely.